Today, we're going to talk about the revenue of a business and its gross profit margin. I will explain to you how to analyze them and what do they mean. First and foremost, we start with the revenue, the first line of the income statement. If you are manufacturing cars and sell 300 of them, each worth 100,000, you report 300 times 100,000 of total revenue for the last year on your yearly income statement. If a company has a lot of revenue, that doesn't mean that it is earning a profit. To determine if a company is profitable or not, you need to deduct the expenses of the business from its total revenues. Let me share with you one of the greatest secrets to making money, and that is just spending less. Who could even imagine that? Under the line for revenue comes the cost of goods sold, also known as cost of revenue. The cost of goods sold is either the cost of materials used in manufacturing or cost of purchasing the goods the company is selling. We should always investigate what the company is including in its calculation of its cost of sales or cost of revenue. This gives us a good idea of how management is thinking about the business. Although it is just a lone number which doesn't tell us much about whether the company has a durable competitive advantage or not, it is essential in determining the gross profit of business, which is a key number that helps us determine whether our or someone else's company has a long-term competitive advantage. And now, if we subtract from the company's total revenue the amount reported as its cost of revenue, we get the company's gross profit. To clarify that a bit more, I will give you a quick example. Total revenue of the car manufacturer was 30 million, less cost of revenue, which could also be cost of materials, 10 million, and we get the gross profit of 20 million. By itself, gross profit tells us very little, but we can use this number to calculate the company's gross profit margin, which can tell us a lot about the economic nature of the company. Gross profit margin equals gross profit divided by total revenue times 100. The companies that have excellent long-term economics working in their favor tend to have consistently higher gross profit margin than those who don't. A good example is Coca-Cola, which shows nearly 60% or better gross margin, or the rating company Moody's around 73%. And this was how you can calculate your firm's gross profit margins. What creates a high gross margin is the competitive durable advantage, which is basically giving you the freedom to price the products or services you sell, well in excess of its cost of goods sold or cost of revenue. Without that advantage, you have to compete by lowering price of the product or service you are selling. That drop, of course, lowers your profit. Companies with gross profit margins over 40% or better tend to have some sort of durable competitive advantage. Companies with gross profit margin below 40% tend to be companies in highly competitive industries, where just competition is hurting overall profit margins. And any gross profit margin of 20% and below is usually an indicator of fiercely competitive advantage industry, where no one's company can create a sustainable advantage over its competitor. While the gross profit margin test is not fail-safe, it is definitely one of the early indicators that the company in question has some advantage over its competitors. If you enjoyed this video, please consider subscribing to my channel for more content like this. Take care and see you next time.